What are the implications for asset allocation in such a scenario, both for the Western world, Harvard, and then I would love for you to maybe dwell upon a little bit about the implications for emerging markets as well, wherein presumably the specter of growth could be slightly higher than what we might see elsewhere, at least in the very near term.
Well, from October of 2012 until February of 2020, I gave a speech. I changed the speech from time to time, but I didn't change the title. The title was "Living in a Low Return World" or "Investing in a Low Return World." And the point is that, most of what Oaktree does is investing in debt, bonds, loans, fixed income, credit. There are a lot of different names for it, but it's lending basically. And the loan, the interest rates on lending were very low, and as I said before, cash yielded zero. Put money in the bank, you got zero. Some parts of the world, of course, you got negative. You bought treasuries, you got 1 or 1.5%, and so forth. So nobody wants those kinds of returns. I recently saw a graph of the holdings of debt in one of the major investment banks' high net worth group, and it basically went from 30 to 20%, the holdings of cash and equivalent securities. People just didn't want it, and so you couldn't get a livable income from debt. Now you can. So I think that debt can, and of course, debt is much safer than equities. Equities has upside. Debt doesn't have upside, but debt has a guaranteed return, assuming that the issuer is money good, and it has stability. You have a promise of repayment, and it has safety. So I think now, now there's a much better place for debt in asset allocation than there was 1 or 2 years ago or 5 years ago. A year ago, one of the things that we deal with is called high yield bonds. Those are the bonds of companies that are below investment grade. Investment grade is a AAA, AA, single A, triple B. That's investment grade. Everything below that is non-investment grade or speculative, starting with double B, single B, then the C's and the D's and the F's, et cetera. And Oaktree is a pioneer in high yield bonds. We've been at it for 44 years, which goes back to the beginning of that business. A year ago, high yield bonds yielded a 4 and something. Well, most of my clients need 7% returns. They're pension funds or endowments or insurance companies or something like that, and they need 7. They can't make much use of things that yield 4 with no upside. So it was very difficult for them, difficult for us. Today, those bonds yield 8. Now they have a real use in our portfolios. So that's just an example. I think that, if you can get the returns you need with a heavy allocation to credit or debt, you don't have to go into risky strategies for those things. People had to do that in the teens because they used to say, Tina, there is no alternative to stocks. I used to call those people handcuffed volunteers. They were going into risky investments, not because they wanted to, but because they had to get the returns they needed. Now they don't have to do it to get the returns they need. So I think this is going to change. You'll probably have less money in equities and less money in alternatives such as private equity.